Dropbox isn't the sexiest business. They don't have the best artificial intelligence story on the market today, but this may be one of the best stocks to buy in the software business today, and that's because they're going to generate a ton of cash flow this year. This is a very high cash flow company, very high margin. Now, they don't have a ton of growth. That's really the downside, so that's what we want to see in the future, but the price is right. Right now, the company's price to free cash flow is a little over 7. That is just an incredibly cheap price for a software company like this, and it's one that I'm intrigued in potentially buying more in the future. So I want to go through that analysis a little bit, what we learned from the recent second quarter earnings report. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content, and thanks to this video's sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. So let's get right to what the market has thought about this company the last year or so. Now, I wanted to start with this to kind of start with a baseline $7.3 billion market cap for Dropbox. And the shares are down about 20% over the past year. You can see it's been a pretty rocky ride. The fourth quarter 2023 earnings results was really what led to this decline that you see right here. And I'm going to give away the lead here. This is really what I think investors should be looking at. The company is expecting free cash flow to be $910 to $950 million. That is a phenomenal free cash flow yield for a company with a $7.3 billion market cap. And management is using a lot of that cash to just simply buy back stock. This is the fiscal 2024 diluted weighted shares outstanding, the average shares outstanding for the full year. And you can see that the number is going to be significantly lower than that in just the third quarter. So it's kind of the difference between two averages. I'll get to what the number looks like right now, but this is trending in the right direction. So what did we learn from earnings? Well, we learned a couple of things. The company is at least back to revenue growth. It's just a little bit of growth, but a little bit of growth is better than nothing, and they're adding subscribers again. So second quarter revenue, $634.5 million. That was up 1.9% from a year ago. Still very profitable with an operating margin of 20%. Non-GAAP operating margin is 35.9%. And cash provided by operating activities, getting close to that $1 billion run rate. Total ARR, annual recurring revenue, was up 2.9% from a year ago to almost $2.6 billion. And the number of paid users continues to increase a little bit, 18.04 million to 18.22 million. And really the way to think about Dropbox is where are companies going to want to store their assets? And I think one of the challenges over the last couple of years is as a lot of these artificial intelligence tools have rolled out, that has really been a suck away from a smaller company that's going to be a little bit more of a horizontal business model like Dropbox. They're going to plug into a lot of different services, but they're not going to be a one-stop shop for everything like a Microsoft is, or even like a Google is. So as those companies add all these artificial intelligence tools, if AI was the draw, then Dropbox would likely be one of the losers, and those two companies would be two of the winners because they're just going to suck all the oxygen out of the room. Customers are going to say, you know what, if we want access to this AI stuff, we've got to put all of our data on their platforms, so we need to leave Dropbox. So it seems like the AI pull has kind of at least slowed down the last couple of quarters, and Dropbox is at least adding a few customers. So the draw of AI doesn't seem to be what it once was. The other thing that Dropbox has done over the last year or so is reduce their costs. So their R&D costs, they had some layoffs. They also got rid of some of their real estate. So you see this if you go through their financial statements, they've got some net loss related to real estate assets. And that was basically just long-term leases that they had, and they just bought their way out of them. So work from home kind of became the way that Dropbox worked in general. The balance sheet, reasonably good. A little over $1 billion worth of cash. I will note, though, there is $1.4 billion worth of convertible notes that the company will have to pay back. And there's also $743 billion worth. Oh, let's take that out. The repurchase program authorized $1.2 billion in 2023. Look at this is what they have purchased over the last couple of quarters. So as the stock dropped earlier this year, they actually got more aggressive with the repurchases. So I think that's exactly what you want to do is you have a company that's generating positive free cash flow and is profitable. If they have weakness in their stock, you want management to just buy that back aggressively. So it seems like they're doing that. They're making all the right moves because they were not quite as aggressive with those buybacks. Now on August 5th, there were 245.9 million shares outstanding. That actually includes an $8.3 million grant related to one of their co-founders, and that's a restricted stock grant. So that's why this looks a little bit higher than the number that you see here, but you can see the downward trend. On a compound annual basis since September 2021, shares outstanding down about 5.5%. Seems like they're going to get even more aggressive with that in the future. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. So why is this stock starting to look attractive? A lot of it just comes down to the valuation that you're paying for shares. So not only could management just continue to buy back stock, given the free cash flow yield, shares could just slowly rise over time, a little over 10%, somewhere between 10 and 15% if they just continue to buy back stock at the current share price. You would get an appreciation as those shares outstanding decline. But the upside is, if Dropbox indeed is turning its business around, it becomes a little bit more attractive platform and storage service with all of the ancillary services that they're offering, even some of their AI tools like Dash. This could be a company that boosts that revenue growth a little bit and earns a little bit higher multiple. I want to get to the multiples, and these are from FinChat. So this is where the stock is trading currently. On a trailing basis, the price to earnings multiple is 12.8. The price to free cash flow is 8.8. And enterprise value to sales is just 3. On a forward basis, so this is analyst expectations for the next year, the price to earnings multiple falls down slightly under 10. Enterprise value to sales is 3.2, and price to free cash flow is just 7.5. So that is a phenomenally low multiple in the software space. So if this is a company that does get back to growth in the mid-single digits, I think we could see multiple expansions. So not only better operating results, but multiple expansion. That's how you boost the stock, is you get those two things working together. Now there's a long way to go for Dropbox to get there, but this is a founder-led company. They have gotten a lot more lean in the business. You can see that operating leverage with the reduction in operating expenses over the last few quarters. That won't continue forever, but it does give leverage if the company is able to grow revenue. It doesn't increase its operating costs at the same rate. So they have the opportunity to potentially buy competitors. That's something that a lot of those bigger companies like Google, like Microsoft are not going to be able to do. They're not going to be able to buy AI competitors. They're not going to be able to buy smaller bolt-on acquisitions. So Dropbox could do some of those things. So I think the risk reward is getting to be more attractive with Dropbox. Not a stock that I have bought recently, but definitely one I'm going to take another look. Maybe another quarter of data points would be valuable for Dropbox, because we do want to see that revenue growth start to tick up a little bit more, especially those user numbers as well. So let me know what you think about Dropbox in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you next time.